All right, everyone. Let's dive into a topic that seems to be on everyone's minds these days. Index funds. I mean, everywhere you turn, someone's got a hot take or a surefire strategy, right?
Hmm.
It's enough to make your head spin trying to figure out what's real and what's just, hype.
Yeah, there's definitely a lot of noise out there. I think it's really easy to get caught up in the excitement, but like with any investment, taking a deep dive into the data is key.
As we were here to do, we're taking a deep dive into the reality of index funds, cutting through all the jargon and getting down to the nitty-gritty. Now, one of the biggest concerns we hear from folks is about inflation. Like, okay, my money might be growing, but so is the cost of, well, everything.
Hmm.
What's the point if my investments can't even keep up with the price of a loaf of bread? Have you heard that one?
Oh, absolutely. Inflation is a real concern, and it's something we need to address head on. Here's the thing. It's not just about how much prices go up. It's about how your investments perform in relation to those price increases. And to understand that, we need to look at the data, which we're fortunate enough to have.
Data.
Data. The Spanish National Institute of Statistics, or the INE, has been tracking inflation for decades.
Okay, so they've got all the numbers. What are the numbers saying?
Well, over the past 24 years, the total inflation in Spain has been 7.5%.
7.5%. That's a pretty significant jump.
It is, but remember that's over 24 years. When you average it out annually, you're looking at about 2.3% inflation per year.
Okay, I see. So it's not quite as scary as it sounds initially, 2.3%. But still, how do our investments stack up against even that?
Let's take a real-world example, the MSCI World Index. It's been around for a while, since 1987.
Okay, familiar with that one. Tracks global companies, right?
Exactly. And since 1987, it's shown an average annual return of 8.67%.
Hold on a second. 8.67% compared to that 2.3% inflation. We're still coming out ahead, even with inflation factored in, right?
Exactly. And that's the beauty of investing. Even with inflation, your money has the potential to grow significantly over time.
Wow, okay. Now that's starting to get me excited about index funds.
And that's just the beginning. There's so much more to uncover about how index funds work and how they can benefit you over the long haul.
Okay, now I'm definitely intrigued. So where do we go from here?
Well, we've talked about inflation, but I think it's time we addressed another big concern that people have, market volatility.
Hmm.
Because those ups and downs, they can be a bit of a roller coaster ride.
Okay, so index funds can potentially outpace inflation. That's a good start. But what about those market crashes everyone talks about?
Ah, yes. Market volatility. It's the elephant in the room, isn't it?
It feels like every few years we hear about another big crash and suddenly everyone's losing their shirts.
It's true that markets can be unpredictable, and there will always be periods of decline. It's a natural part of the economic cycle.
Our source mentions something about a 13-year recovery period after a crash. 13 years. That's longer than some marriages.
Yeah, that's a scary thought, and it highlights why understanding volatility is so crucial. But it's important to remember that those long recovery periods are often based on a specific scenario.
Like what scenario are we talking about?
Imagine someone goes all in on an index fund right before a major crash. They put all their eggs in one basket, so to speak.
Okay, and because the market takes a nosedive, their investment takes a huge hit. Ouch.
Exactly. And if they panic and sell at the bottom, they lock in those losses. Then it takes even longer for them to recover when the market eventually rebounds.
So it's not just about the market crashing, it's about how you react to it.
Exactly. And that's where strategy comes into play. Remember that dollar cost averaging, or DCA, we talked about earlier?
DCA, right. Instead of investing a big chunk of money all at once, you spread it out over time with regular contributions, right?
You got it. Let's say you're investing monthly. When the market dips, you're actually buying more units of the index fund at a lower price.
So you're kind of taking advantage of the dip, buying low. Smart.
And then when the market recovers, those units you bought at a lower price are now worth more, accelerating your gains.
It's like a built-in system for navigating those ups and downs.
Precisely.
Hmm.
And remember that 13-year recovery period. With DCA, the impact of those crashes is significantly reduced.
How much are we talking about?
DCA can potentially cut the maximum losing period in half.
Okay, so instead of 13 years to recover, it might only take 6 or 7. That's a huge difference.
It makes those market dips much less daunting, doesn't it? And that's just one strategy. There are others as well, like diversification.
Diversification, spreading your investments across different assets, not putting all your eggs in one basket.
That's the idea. And there are some well-established strategies for this.
Like what?
One is Ray Dalio's all-weather portfolio. It aims to perform well in various economic conditions.
So no matter what the market throws your way, you're somewhat prepared.
Exactly. And then there's the classic 60-40 portfolio, a mix of stocks and bonds for a balance of growth and stability.
Got it. So we've got inflation, we've got market volatility. Is there anything else we need to be thinking about?
Well, there is one more big one that we haven't touched on yet, taxes. Because, of course, the tax man always wants his share, right?
Taxes. That's right. Sometimes it feels like as soon as you make a little profit, the government's right there waiting to take a cut. So how do taxes work with index funds? Is there any way to protect those hard-earned gains from the taxman?
Well, the good news is that in many countries, including Spain, investment income is taxed differently than your regular income.
Oh, really? So it's not like they just lump it all together and take a big chunk.
Not exactly. When you sell an investment for a profit in Spain, you pay capital gains tax on the difference between your buying price and your selling price.
Capital gains tax. Okay, makes sense. But what are the rates like?
Well, for gains up to 6,000 euros, it's 19%.
19%?
Yeah.
Okay, that's not too bad. And if it's more than 6,000 euros?
Then it depends on the amount, but even the highest rate for gains over 300,000 euros tops out at 28%.
28%. Wow, that's way less than what I pay on my regular income. But even so, wouldn't those taxes still eat into my profits over the long term?
Here's the key thing to remember. You only pay those taxes when you actually sell your investment. So as long as you're holding on to those index funds, those gains can keep compounding year after year tax-free.
So it pays to be patient, literally.
Exactly. And if you want to be even more strategic, there are a couple of things you can do. Have you heard of strategic selling?
Strategic selling. Not really. What's that?
It's basically the idea of timing your sales to minimize your tax burden. Instead of selling everything at once, you only sell what you need when you need it.
So you're kind of spreading out those capital gains over time, paying a little bit of tax here and there instead of one big hit. Makes sense.
Right. And for those with larger portfolios, there's another strategy that can be useful: borrowing against your asset.
Borrowing against your assets. So like using your investments as collateral for a loan.
That's the idea. It can be a bit more complex, but essentially it allows you to access funds without having to sell your investments and trigger a taxable event.
Wow. It's like having your cake and eating it too, right? I mean, you get the cash, but your investments stay intact, continuing to grow.
Well, not exactly eating it too, but you get the idea. It can be a powerful tool for managing your finances.
This has been incredibly eye-opening. So we've covered a lot of ground here: inflation, market volatility, even taxes.
Yeah.
What are the key takeaways for our listeners? What should they be thinking about when it comes to index fund investing?
I'd say the biggest takeaway is this: the real risk often lies in not investing at all. Imagine sitting on your savings for 30 years, doing nothing while inflation slowly chips away at their value. You could miss out on tremendous growth potential.
Makes sense.
Index funds offer a way to combat that inflation, to ride out market fluctuations, and to potentially reduce your tax burden, all while building long-term wealth. But you need a plan. You need to arm yourself with knowledge and information, and then develop a strategy that aligns with your goals and risk tolerance.
Knowledge is power, right? And with the right knowledge, anyone can navigate the world of investing and unlock their financial potential. We've talked about borrowing against investments, but what if you could borrow against future earnings? What would you invest in today to reach your goals faster?
It's definitely something to think about.
It is. That's all the time we have for today. Thank you for joining us for this deep dive. We'll see you next time.